Let's go back to what Kramer was saying. Agree with them, it's kind of a double-edged sword. If you want these rate cuts that a lot of people think are going to help the equity markets, it's probably going to come, especially if you want 50 basis points with some softness in the job market.
Absolutely. I think, we think that this is very much a Goldilocks scenario where you have to get just right, but a little too much could actually spook the markets. I think obviously we've already heard Powell telegraphing that 25 basis point cut. So I think not getting a cut would be incredible disappointment, but getting 50 basis points would really potentially send some shivers into the market, basically saying we could be going into, a steeper slowdown or a recession. That's not necessarily good news either.
I want to ask you, we saw consumer staples hit a record high yesterday. Yeah. We're seeing a shift to defensives and also cyclicals at the same time, which you tell me that seems a bit odd to have people go defensive and cyclical at the same time.
It is really odd. Yeah. I agree. I think the defensiveness is probably kind of what's there. Some of it is also just looking for some valuation. I do think that that's part of the story. But, on the whole, we're in this very interesting moment of uncertainty where we're waiting for the Fed to act, figure out if they can do just enough, but not too much. Are things slowing down enough, to sort of thread that needle? And we're in the uncertainty cycle of what feels like a snap election in the U.S. We have such a truncated, set of election uncertainty during which the market has to adjust to two very different policy stances. Right. So there's a lot of uncertainty right now. So I think you can get a lot of different kind of countercurrents in the market.
It's funny you say the market has to adjust. Seems like Americans just like, oh, different candidate. We're just going to keep going with our day. I mean, I'm not even going to go over all the twists and turns in this campaign.
Yeah.
But it seems like it's been a lot, and people have been like, okay, we'll just keep it moving. I want to come back to something else that a lot of people were talking about, the idea of 25 or 50 basis point cut. Right now, bond traders are pricing in. It's almost 50-50, whether it's 25 or 50 when it comes to a basis point cut. Is there more room to run in the cyclical trade that we're seeing if we only get the 25 basis point cut, or do we need that 50 basis point cut? I'm basically asking, is the idea of a 25 basis point cut already priced in that cyclical trade in your mind?
I think it's priced in. If you look at sort of the way that the bond market, the Fed funds futures have priced this in, they've priced in 100 basis points by year end. That's 3 meetings. So one of those has to be a 50 basis point cut to make that. So that's what's being priced into the market, and you also have a lot of shakiness, quite frankly. So you look at the markets, you look at what's driving multiples right now, and it's still a lot of the tech multiple is still priced in there. And that's become, you're seeing a lot more softness there, and that could kick off a whole series of repricings.
Okay. One last question before we let you go. The de-inversion of the 210, is that meaningful to you? We've been talking about it for 2 years. That's a recession indicator, this and that, and we haven't seen that recession. We haven't really seen much impact or anything tied directly to that data point.
The yield curve has been waiting for Godot, for sure. I do think that it's absolutely, I think it's interesting and important because it has just not, the more we have adjusted to expectations for rate cuts, the long end has actually fallen by more, meaning we're going to keep that inversion going because we don't believe that growth is coming. So I do think that this is meaningful.